Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in. Take a look, see what's going on today. If you want to follow me, it's at @Finance. If you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities, sharing those opportunities with everybody in the community. I do that through midweek updates and weekend question and answer sessions. Special is a coupon code that you can use to get 50% off the first month only on a monthly membership and a $100 discount if you decide to sign up for the yearly membership. And you can always swap from the monthly to the yearly if you would like. So, Dow gold equals 1 with a gold to Bitcoin chart. I know I've shown this before, but I think this is something to watch. It's something to track. Why? Because Bitcoin has never gone through a recession in terms of the overall stock market, stuff like that. It was created after 2008, and it's only been in a big bull market. When gold starts to outperform Bitcoin, which I think it might will, if it does that, it may signal that we are in a different market condition, one that is different than what we've been in since 2008-9 timeframe. So BTC ratio may be completing a 4.5-year flat base and an attempt to break from a 10-year descending resistance. Reverse symmetry to the 2015 level would see gold or real money outperform Bitcoin, digits on a screen, by 200x in the coming years. Go figure. Now, I don't know if it's going to go all the way to the top. I'm not exactly sure about that. That's what he is potentially stating could maybe happen. I'm not exactly sure. I don't know if Bitcoin does a full bust. I don't know if it ceases to exist by having one recession. I don't know. But it's something to watch. That's what I'll say. It is something to watch, and I'm playing the gold silver long game. That's what I'm playing. Why? Because I know it works, and I know when it works. Bitcoin, it's done well, no doubt about that. But I don't know how it's going to react to it, so we're going to watch it. Another one from Dow Gold equals 1. Check out this cool gold DXY ratio channel and clone. And not that, a similar path forward yields $10,000 gold with a 2008 style sell-off along the way. So what is this? What does he have here? So basically, he has a fractal. A fractal is a repeating pattern that occurs over and over. One fractal from 1985, the bottom there with that wick, from to the peak of 233%. We had a very similar move from 2009, 2011. It's the same fractal. We had a consolidation after that bull market run. And that consolidation, you can see we had a big breakout of the channel breakout. We have another big breakout of the channel, which is leading us to another big up move in gold. I like cycle analysis. I think cycles do repeat. I think there are fractals on long term, and I think it's ingrained into human genetics that you can't take out. And it's almost like these events occur when humans want them to occur. It's just weird. Like it's like on a cycle that we can't stop. That looks good for gold. Another one from Dow Gold equals 1. What is the potential of silver? Well, between 1980 and 2001, it lost 99% of its value against the Dow Jones Industrial Average. And that ratio is currently barely off the mat. A return to 2011 levels would see a silver beat Dow Jones Industrial by 4x. A return to the 1980 level sees a 40 times plus outperformance. Now, what do I think we're going to do a 2011 top? Do I think we're going to go back to 1980? I don't know for sure. But I can tell you this, when we went up a lot, we had increasing interest rates that were going in an uptrend. That's what the 1970s were. That was a very fast increase in interest rates. Do we have a fast increase in interest rates potentially in the future? We could, yeah, we very well could. So I think that similar market conditions could come where we could replicate something similar to 1970s up into 1980. And that deals with an increasing interest rate environment. And you're going to hear me talk about interest rate environment a lot. I think that that is a pivotal term in 2020, 2021, where we bottomed and broke out of the 40-year downtrend line in the 10-year interest rate. It is a big, big, big deal. And I think money's going to go into gold and silver more so than what it has even in 2000 to 2011. I think that was a bull market in a corrective phase of interest rates. Now we are in a bull market of precious metals in an increasing interest rate environment, which means less asset classes will work outside of precious metals. So more money is going to go into precious metals. That's what I think. And we could see a huge move in precious metals and in commodities. Howard Marks says there's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. That's one of the most important things you can know about investment risk, says Howard Marks. Silver 8 King, I think this is Eric. Every silver run starts quiet and ends with people panicking. Silver at $30, counter one, and then silver at 100, everybody wants to be in line to purchase it. That's herd mentality. My purchases, I killed it. Yep, I'll pat myself on the back a little bit. I bought a whole bunch underneath 20 bucks an ounce. That's where the majority of my holdings. You could maybe adjust it to 23 because I did buy a good chunk at say like 21, 22, 23. I had some good deals, let's just put it that way, that I purchased at that time. Now, I don't know. I'm not as inclined to go out and run and go buy a bunch of silver at this price. Other people, they buy it because it's going up. That is it. That is what everyone is programmed naturally. They are programmed to go out there and just chase crap. That's all it is. The herd just wants to chase crap. Oh my God, did you see the returns on Nvidia? Well, did you buy it low? No. Why would you buy it all the way up here? You want to buy stuff when no one else is buying it. You want to buy it when it's cheap. And that's how you make money. That is it. It's as simple as that. The more fear there is in the market, the better. And the less willing everyone else is to buy it. They're going to say, well, that's really risky. It's gone down 50%. And that's the same reason that I'm buying it. It's gone down 50% and the risk is a lot less. And that's why I want to buy it. Down to high heat. Global oil demand is strong. It's over 105 million barrels per day. Demand for paper money, not so much. Yeah, people don't want paper dollars. Now, as they print more money, that is the oil demand. That makes sense. As they print more money, and as oil is the number one commodity in the world, the money printing is demand for oil. Oil is in everything. So if they print money and it goes into products, well, that's demand for oil. So if our demand is over 105 million barrels per day and they continue to print more money, the demand for oil is going to continue to go up. It's a very inflation sensitive asset. Eric Yoon says, when I read BJ Milkshake and his buddies' posts, I am really careful. I read them multiple times and do tons of background research. Almost 99% of the time, they are either outright lying or obfuscating on the details to push the BS narratives. That's his opinion. Do I agree with it? I don't really care. I don't think the milkshake theory is necessarily right. I think it describes a certain market condition that occurs over time. It's not really a theory. I just think it's a condition that can occur over time. And then I think that condition is gone. I don't think people are going to want to hold dollars here. I think Canadian dollar is going to outperform. I think the Australian dollar is going to outperform here soon. And that the dollar's value in relationship to other currencies is going to go down. That's why we're seeing a breakout in international equities, emerging markets, and money's rotating. So he's wrong that it's going to continue any longer than what it has. It's just part of the cycle. The cycle goes from 2008-9, which was the bottom, all the way to wherever this thing peaks out at. And then we're going to go into a big commodity bull market. The dollar's going to get weaker against those other currencies, and that's all part of the cycle. And everybody just wants some sort of narrative to latch onto. They want to believe something. They want to believe that these people have it all figured out. Now, am I saying that I have it all figured out by these ratios and the cycles? Well, I like to think I have a better reading on it than what I used to, but it doesn't mean I'll be perfect. Eric Yoon says, the Fed can only control short duration U.S. Treasury yields. If the long duration U.S. Treasury yields stay high after the Fed cuts rates, the yield curve will steepen. That's very good for commodities. It will be another sign that sovereigns are voting distrust in U.S. Treasury bonds, or in the case of U.S. allies, they have no more blood to give. Steepening yield curve means that this drops on the short end, this stays elevated on the long end. The increasing gap between long and short-term rates is a steepening yield curve, is what he means. And the longer end, the years of maturity, stays high. The short end stays low. And then you get this difference between the short end and the long end. And that steepens that curve. Oil always has its bull market in a gold bull era. So the clock is ticking. The roadmap for $300 crude oil from Patrick Karam and Northstar. How much more pain for oil until the breakout? Yeah, the recession, we're in it. I don't know if it's bottomed yet, but I can tell you the equities have already bottomed, a lot of them. So I've already taken positions based off of the equities and how they are trading on their technical analysis. Now, he has a fractal, A1, B, 2, and C. A1, B, 2, and C. It's the same fractal, correct. And then we're going to break out of this squeeze down, falling wedge to the upside and have a big third leg in oil. The difficult part that most people don't understand is the recession done? Is it still ahead of us? Does that matter? It doesn't matter. Do you know what matters? What matters is how people, big money, is positioning in the market. They buy bottoms. I want to accumulate when they are accumulating because I want to buy the bottom. So the narrative of if we're in a recession or is it behind us, it doesn't matter, guys. What matters is if people are positioning in the equities that I want to purchase. That's what matters. It's almost like going back to where I used to work. They'd focus on all these pieces of data, and I'm like, none of these matter. They're not going to make your business better by focusing on this data. It is what it is. But leading indicators, if we need to change something, then we need to follow the leading indicators, not this other data that you want to follow. And the charts is what you want to follow. Now, this hasn't broken out yet. But you know what has broken out? The equities in a lot of different companies. What does that mean? It means that people are positioning in the equities before the commodity bull market gets going. They're ninja buying. Ninja buying is when you buy when no one else is noticing. You buy it in the background when everyone else is staring the other way, because that's how you get the cheapest prices. Free domain, Stephen Molyneux, I used to listen to him every once in a while. He says people are so economically illiterate that they think inflation means rising prices. Agreed. Inflation is inflating the money supply. Prices follow the increase of the money supply. What they do is they try to trick everyone to believing that rising prices is inflation. They don't want you to focus on what the root cause of inflation is, which is money printing. How do you stop money printing? That's the question. Well, you can't, because the design of the system needs to continue to inflate in order for it to survive. You can never pay back the debt. It is impossible. Why is it impossible? It's the design of the system. So people say, oh, well, we'll just pay back our debt. It's not how it works. If everyone tried to pay back their debt and all of the paper currency in the world vanishes as it extinguishes debt, did you know that you would still have copious amounts of debt left? Did you know that? It is impossible to pay back the debt in its entirety. And you know who has that debt? Banks do. And you know what it's loaned out against? Real assets in the world. Okay, so Andy, tell me this. If we don't have the paper currency and the value of the currency to pay back all the debt, then what happens to the debt if we can't pay it back? It goes back to the banks who have loans against it. Okay, so what collateral did the banks put up against those assets if the paper money in the system doesn't exist? That is the question you should ask. And it doesn't matter if you bring it to court and say that they didn't put up appropriate collateral against, let's say, a loan that they gave you for a home. The judicial system, the judges and everybody in the system has to basically come to the same conclusion as the banks want them to come to, because they don't want the system to fail. If they were 100% ethical and they said, you know what, you are right, the banks didn't put up appropriate collateral against all these loans. And if that was the case, then the loans should be abolished. They should be removed. And the banks should be dissolved. And our money system should be replaced with gold and silver as money, like our Constitution says. Anyway, Brady says this weekend, or the weekend is for stepping back and looking at the very big picture. Silver's breaking out above the 15-year previous resistance high on the quarterly chart. We have a breakout in silver. Now, some people are going to say, well, should I sell silver? No, guys, we just broke out. We just broke out. This isn't the time to be selling. Could we get a pullback? Yeah, I'm not playing it, though. I'm going to play a short-term little market move pullback to 38, 38.50 if that occurs. I'm going to try to time the short-term market movements on the largest breakout cup and handle pattern in the history of mankind. I'm not stupid. Come on, guys. I'm going to ride this thing. I'm going to ride way up. Javi says, what may seem like one of the most illogical moves to many looks highly compelling to me in today's macro environment. The goal isn't to be contrarian for its own sake, but to pursue a thesis that is fundamentally strong and widely underowned. That to me defines emerging markets today. In addition to rising commodity prices, two key forces drive these economies: a weaker dollar and suppressed U.S. yields. Both seem likely ahead in my view, given the scale of the debt burden and the structural twin deficits we are now facing. This is the Emerging Markets FX Index, so Deutsche Bank EM FX equally weighted spot index, breaking its downtrend. Well, what does that mean? It means we're at the beginning of this. It's starting. It's just starting. And this is a good thing. We have a long way to go, and we're at a very low level. And we're just starting to break out. This is what we've been waiting for a few years. We're waiting for all these things to start to break, and that's exactly where we're at. David Bateman, he went all in on gold and silver, platinum and palladium, basically. Why would you buy a 2-year US Treasury bond earning 3.5% interest when you could buy gold at 35% year-to-date returns or silver at 39% year-to-date returns? The world is waking up to the fraud of fiat currencies. Central banks are fleeing the dollar. Your broker and your ignorance is the only thing standing between you and generational security. Well, what I would say is we're not buying gold or silver to get those returns of 35%, 39%, even though I think the returns are great. We're buying it because 2-year US Treasury bonds earning 3.5% interest and an inflation rate that's probably over 10%. That's why we're buying gold and silver. Because the alternatives is you got to get out of it. You can't be sitting in dollars. You can't be sitting in the bonds because you're just going to lose your purchasing power. So you have to go somewhere that's going to increase purchasing power, which is gold, silver, platinum, palladium, and other hard assets. You're getting the heck out of dollar-denominated financial assets. That's it. Uselink, the almost pure uranium mining ETF, is breaking out versus the overall energy sector XLE. Could be. There's the chart there of the ratio. I did post something back. I said double bottom of XOP to URA, big rising wedge breakdown into a potential double bottom. Maybe. And that's XOP versus URA. So you got to be careful on what you use and what you're comparing. Things aren't as simple. Art Berman says OPEC's increase is really a squeeze. Most members can't pump more or can't sell cheap. The net effect, less oil than bean counters think. So all these increases, what if they don't have the oil? We'll see. We'll see if they can pump it. If they don't, okay, whatever. If they can, well, we'll see it in the inventory numbers. Here's XLE. Energy hasn't had any in over 3 years. So we have a nice little double bottom. Big move up. We've had a consolidation. Do you know what this consolidation is? It's the same consolidation that gold had from August 2020 to September of 2022. September of 2022 is where the blue arrow is. That there is, if you add 2 years, April of 2022, add 2 years, puts us at April of 2024. You know what? August of 2020, and then the bottom was when? September of 2022. That's 2 years. This is a 2-year moving sideways. Do you know what time it is? I think it's almost time where XLE starts to outperform again. We're getting close. We're getting close. Fed rate cuts are gold's rocket fuel. They print, gold wins every single time. Gold up 118% when they lowered interest rates from 2008 crash. The COVID crisis, big move up in gold. And we are going to lower interest rates and gold is rocketing higher. What does that mean? It means that the safe haven asset is gold. And that if they lower interest rates, gold will account for that. Do you know what comes right behind that? A big move in base metals and a big move in oil. So gold is in its running phase. This is the pause there. That's August 2020. Bottom here is September 2022. That's 2 years. We come on up a little bit longer, and then it ran. Oil is going through that same pause right now. That pause is going through, oil is going through. When these get lowered, And whenever it gets to a certain point, oil is going to start to take off. I don't think it'll be right off the beginning, but it'll be kind of lower. Maybe it'll be 2026 or something like that, or earlier. And that's all I've got for today. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special is the coupon code. And that's all I've got. So we'll catch you next time, guys. See you.